speakers and all participants, I humbly request all of you to open up your camera and let's have a brief moment of silence as we want to sing Indonesia National Anthem, Indonesia Raya. Thank you very much. Good morning, good afternoon, and good evening. Mr. Luhut Binsar Panjaitan, Coordinating Ministry of Maritime and Investment Affairs of Republik Indonesia. Professor Wimbo Santoso, Chairman of Indonesia Financial Services Authority OJK. Profesor Jamal Wiwoho, Rector of Universitas 11 Maret. Professor Lucian Taylor from Wharton School, University of Pennsylvania, USA. Professor Caroline Flamber, Columbia University, USA. Professor M. Kabir Hasan, University of New Orleans, USA. Dr. Renata Skizis, University of Southampton, UK. Dr. Putra Pamungkas, University of 11 Maret, Indonesia. Vice Rectors, Deans, UNS top management members, and all participants. Assalamualaikum warahmatullahi wabarakatuh, and welcome to International Webinar Sustainable Finance and Impact Investing, organized by Universitas 11 Maret and supported by Indonesia Financial Services Authority OJK and UNS Fintech Center. Ladies and gentlemen, and I'm Dewanti Chainingsi, a moderator for today's ceremony, and then it's such a big honor for me to be part of this significant event. And to inform you that this webinar is also part of the series of agenda of Universitas 11 Maret 46th anniversary, and also the side event of G20 Indonesia Presidency in 2022. I would like also to inform you that this webinar is also broadcast live from the UNS Fintech Center YouTube channel and also Jasa Keuangan OJK YouTube channel. And proceeding to the first agenda of today, it's the opening remark by the Rector of Universitas 11 Maret, and I would humbly invite Professor Jamal Wiwoho to proceed to stage, and platform is yours.
Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, and good evening. The Honorable Mr. Luhut Binsar Panjaitan, Coordinating Minister Maritime and Investment Affairs, Republik of Indonesia. Profesor Wimbo Santoso, Chairman, Indonesia Financial Services Authority, OJK. Profesor Lucian Taylor, Warlon School, University of Pennsylvania, USA. Profesor Caroline Flammer, Columbia University, USA. Profesor M. Kabir Hassan, University of New Orleans, USA. Dr. Renatas Kaisis, University of Southampton, UK. Dr. Putra Pamungkas, Universitas 11 Maret, Indonesia. Vice Rector, Dean, UNS top management members, and all participants. I would like to welcome you to international webinar Sustainable Finance and Impact Investing. Speaker and participants, tomorrow our university will celebrate the 46th anniversary, and this event is a series of agenda that we prepare to celebrate it. This international webinar is also side event support G20 Indonesia Presidency 2022. Tonight, webinar has a topic focused on sustainable finance and impact investing, as the global awareness of taking environmental, social, and governance (SEG) considered into account when making investment decisions in the financial sector getting higher. UNS as one of the leader higher education institutions willing to take a part to promote this issue. On this occasion, I would like to say thank you to Indonesia Financial Services Authority, OJK, to fully support the international webinar. Respectable invited speaker who willingly attend this event. I'm sure tonight we have a fruitful discussion, as we have a list of notable invited speakers, and hopefully you can fully enjoy the whole event. Wassalamualaikum warahmatullahi wabarakatuh.
For such warm welcoming remarks. All distinguished speakers and all the participants push on to the next agenda is the keynote speeches. And as today's international webinar is quite special, we will have two keynote speeches that will be addressing our theme of today's webinar, which is sustainable finance and impact investing. And it is privileged to bring you to the first speaker for the keynote speech today, Professor Wimbo Santoso, Chairman, Indonesia Financial Services Authority, OJK, as recently OJK launched Indonesia Green Tech Summit Edition 1.0 in early 2022. So without further ado, let's proceed and meet Professor Wimbo Santoso. Platform is yours.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Distinguished Excellency General Luhut B. Panjaitan. He is also the Coordinating Minister on Maritime and Investment. Selamat malam Pak Luhut. Also distinguished Professor Wibowo. He is the Rector of University of 11 Maret, Surakarta. Also distinguished Professor Taylor from Wharton School, University of Pennsylvania, USA. And also Professor Flammers from Columbia University. and also Mr. Kapi Hassan. He is Professor at University of New Orleans, USA, and also Associate Professor Renate Kezis from University of Southampton, United Kingdom. Also, Dr. Putra Pamungkas, economist from 11 Maret Universities. College, ladies and gentlemen, good evening to all of you in Indonesia, and good morning for all of you in the US and also around the world. First of all, I would like to express my appreciation to the distinguished speakers, our audience, and also invitable people to attend the today discussion about sustainable finance and impact the investing. It is, and the topic is very, very timely to be discussed. Especially this topic is also part of the main agenda of Indonesia G20 presidency, which tagline is recover together and also recover stronger. Then on top of this, the G20 member is actually one of them is Indonesia. Then Indonesia is the only country in ASEAN being the member of the G20 because it is a top 20 large 20 country in the world. So that why we do hope that Indonesia will be lead by example in implementing the sustainable finance agenda. Ladies and gentlemen, I believe this agenda, on top of this, also the main agenda of the G20 presidency in Indonesia. We are now in the midst of recovery from the COVID-19. We understand that the impact of the COVID-19 is really, really extraordinary and never happened before. So that why we come up with a lot of agenda in the midst of how we speed up the recovery of our economy globally, not only Indonesia. A lot of policy has been implemented in 2020 and also the 2021, how to bring the country sustain and actually survive from the COVID. And then we all effort not only about the how to healthcare policy, vaccine distribution, but also how to distribute the benefit for the people to make sure that people can still survive, for their life, and also the business can survive from their activity. Then actually also the financial sector is very important. So that why now we are in the midst of the process of recovery. I believe around the world, we have see the table that around the world start, getting a higher growth compared to 2020. As like the advanced economy, especially in the United States, the growth 2021 is 5.7%. Then also United Kingdom even higher, 7.2%. Indonesia, 3.7, not too bad. Then India is 9%. So China is 8.1%. So even we can still have a very optimistic growth by 2022 this year. But of course, it's not easy for us, First, because now we come up with situation and the global disruption on the supply chains. And the supply of the commodity and resources actually been not smooth that we expected before. So that while creating, imbalance between supply and demand. So that while the inflation is growing everywhere in the world, especially in the United States, year on year, it's 7.5, United Kingdom 5.5, and also Eurozone 5.8%. So now in the global economy start, how to mitigate about the high inflation, global supply chain disruption. Then, of course, the impact of the normalization in the expand country will spill over to the emerging market. So we are afraid that will be uneven of recovery. So what we can do in this kind of situation? Additionally, we just recently, geopolitical tension between Russia and Ukraine also created another pressure toward the global economic recovery. So what we can do in the midst of this kind of recovery, actually is difficult answer around the world. I think the most acceptable statement is just keep going, mitigate all those kind of the spillover because of those kind of the situation, and then find and explore new engine of growth, each country with their kind of the country circumstances. That's the only answer. Then on top of this, that is the main discussion. This event is about the sustainable finance. There's another agenda, the actually global agenda that any country in the world is not going to be escaped from this agenda. So I would like to really to give a little bit on the background about this sustainable finance agenda. Especially Indonesia. Indonesia is a rainforest country. We have 272 million people around. The national geography, then actually most of the growth of the economy because of the domestic consumption. Then actually export is more on the national resources. So in that way, Indonesia is the most actually important, to be lead by example of the implementing the sustainable finance agenda. Actually, on top of this, because it is a commitment of the global commitment, especially Indonesia, to reduce the 29% emission on the Paris Agreement, with the without the support from international, then 41% get support from the international. So we have a national determination agenda, how to really to reduce this kind of sustainable finance agenda, on the reduction on the emission. Then, of course, it's not easy. Then, additionally, actually, on the COP26, globally agree that we should come up with net zero emissions by 2060. Then, of course, each country has own, effort how to make sure they are moving toward the zero emission by 2060 going forward. Ladies and gentlemen, Indonesia actually, especially on the how to bring the agenda of towards the net zero emissions. Government, and also all the stakeholders, including the supervisory authority and the financial sector, OJK, actually committed really to support this agenda. Then, especially OJK, we concern on the sustainable finance and also blended finance. Government has set up, we call it the working group on this to have a transition on this. They actually OJK is part of the working group 4 on the sustainable finance and blended finance. Our for the future, then actually in this kind of the today discussion, I would like focus on the what OJK has been doing in order to bring this agenda around the table. First, actually, OJK has released, we call it the Sustainable Finance Roadmap, first phase. in 2015. I think the first phase is covering 2015 to 2019. Yeah, I think the first agenda was really to raise awareness of the people and also financial sectors. Yeah. Then we released some of the regulation, on the sustainable finance, and also we released regulation on the concerning how to stimulate a green bond. Then also we have give incentive on the reduction of the some of the registration fee and also other fee of the raising fund in the capital market in this case. So I believe with this kind of the incentive, people will be interested, to come up with the platform of the sustainable finance. Then I would like to share what we've been achieved by in the first roadmap of the sustainable finance. First, actually, Indonesia actually has issued, we call it the Global Sustainability Green Bond by PT Bank Rakyat Indonesia (TBK), $1 billion. And also the PT SME, that is actually under the Minister of Finance, $500 billion. PT Bank Mandiri, $300 billion. And then, PT SME is 500 billion Indonesian rupiah. Yeah. Then also the blended finance is worth $2.46 billion. So also a lot of effort that we've been achieved in the first agenda of the sustainable finance in Indonesia. So going forward, that we have issued, we call it the second phase on the sustainable finance in Indonesia, covering the period of the 2021 to 2025. That actually we've been more aggressively give some of the roadmap, about how that we provide a basis for the people understanding about in the field about the sector and subsector that have been considered as part of the green, or we call it the green taxonomy. Then also we support actually how do people understand, understand about the awareness and also the concept and also the roadmap of the sustainable finance in Indonesia. So we collaboration with all government agency, stakeholder, other stakeholder, university, and also the activists, to come together to develop this. And also especially we just released, we call it the green taxonomy. The green taxonomy actually is a basis for everybody, not only OJK. For the sectoral piece, to provide the incentive, of the people to raising fund or to borrow the money, which considered as the green taxonomy. Of course, will be considered as three indicators: green, yellow, or red. Then, of course, the green will eligible to receive the incentive. The yellow, actually, it is harmful, actually, but not really significant. And the red is really very harmful. Of course, the disincentive will be there. In terms of the financial sector, as I mentioned before, in the banking, we will give some of the incentive of the more lower risk-weighted asset in the capital charge. Then, of course, will be another color. Two color will be, of course, will be more expensive in terms of the capital charge in this case. Also, in the capital market, the same thing. We will give some of the incentive at the end. since we can raising fund, and then our project can consider as part of the green taxonomy. Then I believe this kind of the basis of understanding and being supported by the whole stakeholder Indonesia. And also now in the global, we still discussing about how about the green taxonomy that we feel acceptable in the global agenda. We are discussing in the Financial Stability Board now. Then also in the ASEAN, we have on the ASEAN Green Taxonomy Board. We are still in the discussion. Now we have around 5. Now I believe 1, 2, 3, 4, or 7 countries now that been released the green taxonomy and their own jurisdiction. So actually Indonesia is one of those countries. I believe going forward that this will be still being improved because the green taxonomy that we release in Indonesia, we call it 1.0 green taxonomy that actually will be covering 2,733 sectors and subsectors. Then actually we will upgrade all along the way. Then hopefully actually with this kind of the effort, all of the business people, government agency will support about the implementation of the green taxonomy, especially in Indonesia. Again, going forward, we also support the agenda of the government about the how to establish, we call it the carbon economic value. The government been released a presidential regulation number 98 about the carbon economic value. Then also we develop, we call it the carbon trading in Indonesia. And then hopefully Indonesia will be center of carbon trading globally. Then OJK with the government, especially under direction from Pak Luhut, very supportive and very pleased, whatever the decision of the government, even the capital market will be assigned being, the exchange traded of the carbon credit, I think will be ready. Then actually, and then really we 100% support the agenda of the development of carbon trading in Indonesia. Ladies and gentlemen, actually on top of this, because how to bring the recovery of the economy, first, not only agenda that related to the recovery together and stronger, but also about this, how that we implement the sustainable finance in Indonesia is also very important. Nevertheless, I believe the SME is also one of our agenda to make sure that SME will be also part of our agenda on the how to bring the recovery faster in the midst of the the agenda of the sustainable finance, and also the agenda of the the normalization of the our monetary and fiscal policy around the world. Hopefully, the seminar will be fruitful. Then, and I thank you for Universitas Plus Maret. There's been a collaboration with OJK to develop the seminar, and then we are grateful to have further discussion afterward. Then finally, the discussion will be useful for us, globally, not only Indonesia, actually to recover from the post-COVID, and also really to implement the green economy agenda around the world. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. And thank you very much, Professor Wimbo Santoso, for delivering such a comprehensive speech on how committed Indonesia on addressing global awareness. And also we can see how in the presentation of Professor Wimbo that Indonesia is highly committed to addressing the sustainable finance by organizing sustainable finance roadmap and then green finance landscape, And we heard also about the Indonesia Green Taxonomy Edition 1.0 and to enforce the goal of the G20 Indonesia Presidency 2022, recover together, recover stronger, using the SMEC to manage the post-COVID and sustainable finance itself. So thank you very much, Professor Wimbo. And proceed to second keynote speech of today that will be delivered by Mr. Luhut Binsar Panjaitan, Coordinating Minister, Maritime and Investment Affairs of Republic Indonesia. Without any further delay, ladies and gentlemen, proudly brought to you Mr. Luhut Binsar Panjaitan. Platform is yours.
Assalamualaikum warahmatullahi wabarakatuh. Good morning, Chairman of Indonesia Financial Service Authority, Dr. Wimbo Santoso, Rector of University 11 Maret, Professor Jaman Wiwoho, distinguished guests and speakers, ladies and gentlemen. First of all, I would like to convey congratulations and success for the University 11 Maret in organizing this webinar on sustainable finance and impact investing. I believe understanding of these topics is key in this era of sustainability. As we have entered March, the COVID-19 is officially in Indonesia for the second whole years. We may remember the early 2020 when almost everybody was surprised by COVID-19 that spread quickly and took the life of more than 6 million people in the world, in the whole world, or 150,000 people in Indonesia, which is, I think, the number is very, very big. At the end of 2020, there was hope for the situation in 2022 due to the emergence of vaccines. However, uneven vaccine distribution and speed of injection between countries led to the emergence of new variants. The Delta variant, first detected in India in the mid-2021, entered Indonesia and created a second wave with peak cases around 3 times as much as peak cases during the first wave. In line with this highly transmissible nature, in almost no time, hospitals in Indonesia were swept with the COVID-19 victims, and a lot were unable to get oxygen or treated in due time. The second wave was managed by a restriction of people activity in emergency PPKM that was successfully implemented thanks to a great coordination between us all, the government, law enforcers, experts, industry, and people. As we have learned from the managing of the first wave, PPKM was relaxed gradually by level according to the situation in each region. We also encounter or encourage faster vaccination and 3T, testing, tracing, and treatment, including the use of Peduli Lindungi, so that the economy can be opened safely. This strategy proved effective even up to the Omicron variant. As 8th of March, the case have gone down by 53% from the Omicron peak 16th of February. We continue to continuously monitor the pandemic development, including possibility of worsening variant. However, now we can gradually and prudently open our economy. Distinguished guests, ladies and gentlemen, despite our success, COVID has highlighted lack of long-term preventive measures in Indonesia. For example, our hospital bed and healthcare worker numbers are lower than recommended by WHO guidelines. Now, furthermore, active pharmaceutical ingredients, API, are mostly imported that we had trouble securing them during the heights of Delta wave. The bitter lesson has been learned. A reform is in order. We must be prepared for long-term, crucial challenge, starting in our eyes, climate change. Indonesia has pledged to reduce a minimum a minimum of 29% of its business as usual emission by 2030 under the Paris Agreement. Indonesia included carbon taxing measures. It is a new law on taxation number 7 of 2021. In the next few years, we will also develop carbon trading system and its implementation of the Presidential Regulation number 98 of 2021 concerning the economic value of carbon that will further our commitment in reducing emission. Nevertheless, it is estimated that the financial need to curb emission reach 266 trillion rupiah, whereas the budget APBN can only fund around 87 trillion rupiah of aid. There are several measures that the government has prepared to encourage the participation of non-public funds. For example, Green Sukuk, first issue in 2018. We also prepare blended finance approaches, for example, emission transition mechanism with aid from ADB that will pool investor and donor funds to finance early retirement of coal power plants. Fortunately, private sector are nudged to become greener by their increasingly climate awareness consumer, and we are blessed by abundance of natural resources that can be utilized in response. For example, Volkswagens buy carbon credit from Indonesia in order to make their life cycle emission carbon. Indonesia is preparing green industrial parks such as North Kalimantan that has large potential for hydropower plant and available resources to reduce high value added goods such as aluminum, petrochemical and polysilicon. Many investors are also interested in financing an Indonesian EV ecosystem plan, as Indonesia has key commodities to make the battery and vehicle components such as nickel, cobalt and copper. Distinguished guests, ladies and gentlemen, at the end I would like to highlight how climate change could wreak havoc upon all of our lives. Thus we need to take it seriously. Despite potential funding challenge from public sectors, Indonesia has the benefit of rich natural resources that is certainly attractive to private sectors and donors. Technology innovation and capable human capital will also be key in solving this challenge. Thus, I invite scholars here to give us valuable inputs on how to manage climate change with available funding. Our success in controlling the COVID-19 pandemic has shown us the importance of cooperation in solving any challenge. We are a big nation and we need to be optimistic, yet not arrogant to credit advance Indonesia 2045. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you very much, Mr. Coordinating Minister, Mr. Luhut Binsar Panjaitan, for once again showing to us how highly committed Indonesia government is to address the climate change and then the COP26, and also to translate those kind of commitment into implement sustainable finance. And as Mr. Luhut said, that understand the whole concept is the starting point to really implement it into the real world. Invited all speakers and then participants, and before we proceed to the main agenda, the international webinar, I think it's a good opportunity for us to document this picture by having a virtual photo session. So I would like to invite all of the participants and also speakers to open the camera app, and we will have the virtual photo session together. So thank you very much for opening up the camera for tonight. On count of 3, everyone, 1, 2, 3. Have a very big smile for our webinar today. So, thank you very much. Ladies and gentlemen, thank you very much, Professor Wimbo and also Mr. Luhut, for delivering such a comprehensive understanding on how Indonesian government translated sustainable finance into the real implementation. And all of the speakers and also, ladies and gentlemen, the participants of this webinar. So let's proceed to the main agenda of today. It's the webinar on sustainable finance and impact investing. Joining with us today, 5 notable speakers coming from all over the world, 3 for US and 1 from the UK and 1 from Indonesia. So let me greet one by one. Professor Lucian Taylor, professor from Wharton School, University of Pennsylvania. Very good morning, Professor.
Morning.
Very good morning. Thank you for attending this webinar. And next we have Professor Caroline Flammer, Columbia University, USA. Very good morning, Professor Flammer. Thank you very much.
Good morning.
For
good
joining.
evening, everyone.
Thank you. And then we have Professor M. Kabir Hassan from University of New Orleans, USA. Assalamualaikum, Professor Hassan.
Waalaikumsalam. Good morning and good evening to everyone.
Thank you very much. And Dr. Renata Kizis from the University of Southampton, UK. Very good afternoon, Dr. Kizis. I'm afraid that you are still in mute.
Sorry about that. So, good afternoon in the
So-
UK. Good evening in Indonesia. Thank you.
Thank you very much. And last but not least, Dr. Putra Pamungkas from Universitas 11 Maret, Indonesia. Very good evening, Dr. Pamungkas.
Good evening, Dewanti. Good evening, everyone.
Thank you very much. So, ladies and gentlemen, once again, welcome to the webinar session on sustainable finance and impact investing. As we see that in the past few years, the global awareness on taking into account environmental and the social issue and also governance into finance area is quite high. And today, without further ado, we will proceed to the first speakers today. And then before that, I will inform to all of the speakers that each speaker will be given 10 to 12 minutes to deliver the material. And after, we will have a question and answer or discussion for about 30 minutes. So for all of participants, please feel free to put your question into the chat box. Probably the speakers are curious why in our chat room, we only have like a few people because we have two platform for tonight. So in one room, it consists of the speakers and the participant. That for now we have like 100 participants joining live, and also they can access our meeting today through the YouTube channel of the Indonesia Financial Service Authority and UNS Fintech Center. So ladies and gentlemen, without further ado, let's proceed to the first speakers for today. Professor Taylor, Professor Lucian Taylor from Wharton School, University of Pennsylvania, USA.
Thank you very much. Hello, distinguished hosts, distinguished participants. It's a great honor to be with you today.
I'm sorry to cutting you off, Professor, but
No
before
problem.
that, I would like to introduce you to all of the participants today with your
Please.
a little background. So ladies and gentlemen, Professor Lucian Taylor is a John B. Neff Associate Professor in Finance, the Wharton School, University of Pennsylvania, USA. She also served as a co-director of Rodney L. White Center for Financial Research. And he holds a PhD in finance from University of Chicago Booth School of Business. And he also have a numerous of awards. Some of them is AQR Insight Award as a distinguished paper. And also in the same year, in 20 and 21, Professor Taylor also won a paper prize for best paper in a Jacob Levi Center research. So without further ado, ladies and gentlemen, proudly brought to you, Professor Taylor. Please, platform is yours.
Thank you very much for that warm welcome. It's a real honor to be with you today. I will go ahead and share some slides with you. I want to talk to you a little bit about some research I've done called Dissecting Green Returns. Now, this paper is about the dramatic rise that we've seen in sustainable investing, also called ESG investing. This rise has been one of the most dramatic stories that we've seen in finance over the last decade. And we wrote this research paper because we noticed some, I'll call it sloppy thinking about the difference between realized returns and expected returns in this space. So in our project, we're asking, should we expect superior returns from sustainable investments? If you ask that question to investors, they often say yes. You see that if you look at these 3 surveys of investors that I've cited. Asset managers, they often say yes as well. For example, here we have the CEO of BlackRock saying, integrating sustainability can help investors build more resilient portfolios and achieve better long-term risk-adjusted returns. And if you look at the data, you will see superior historical performance on certain types of ESG strategies, so strategies that focus on environmental, social, and governance factors. So a lot of people answer this question, yes. We reach the opposite conclusion. We say no. We say you should not expect superior returns from sustainable investments. There's a theoretical part of that answer, and this comes from a recent theory paper we wrote. So according to basic economic logic, sustainable investments should have lower expected returns for two reasons. First, there are a lot of investors out there, ESG investors, who like holding sustainable investments. That has bid up those investments prices, so they have high prices today, which means they have low expected returns in the future. The second reason is more about risk. We argue that sustainable investments are safer because they offer a hedge against climate risk. And since they're safer, investors are willing to accept lower average returns, expected returns, to hold them. In the paper I'll talk about today, we offer supporting evidence. We show that the past superior performance we've seen on sustainable strategies was unexpected. Our story is that climate concern, so our concern about climate change, has increased more than was anticipated over the last 10 or so years. And that led to two big events. First, investor demand for sustainable financial assets unexpectedly increased. And that led to, that pushed up the prices of, I'll call them green assets relative to dirty assets. And the second thing that happened, as we became more aware of the climate crisis, customer demand for sustainable goods and sustainable services increased relative to the demand for unsustainable goods and services. And that's a second reason why the past returns of green assets have been relatively high. The broader kind of message from our research is that the past performance of sustainable strategies is not a good indicator of their expected future performance. Let me start by offering a simple case study that makes our point, we hope, in a clear way. This is the example of German twin bonds. So the German government has been issuing sovereign green bonds since 2020. And what's interesting about the German green bonds is that each of these green bonds has a conventional twin bond. They are both sovereign German bonds, but one is labeled green. It's used to finance the sustainable parts of the German budget. The other bond is not labeled green. So again, these two bonds, they have the same issuer, maturity date, coupon rate, coupon payment dates. These bonds have identical future cash flows. The only difference is that one is labeled green, one is not. So it's useful from a research point of view because it offers an experiment that lets us ask, how does greenness by itself influence expected returns? How does greenness influence realized returns? So let me show you the data on one set of these twin bonds. I'm plotting here the bond's yields to maturity. The green bond is shown in green and its twin is in the blue line here. And all the yields were negative. This was a period in Europe when there were negative yields. That doesn't matter for us. But what should be popping out here is that the green line is always underneath the blue line. The green bond always offered the lower yield to maturity. And that's interesting because yield to maturity is a good proxy for expected return on the bond. So what we're seeing here is that the green asset always had a lower expected return. I'm going to take next the gap between the green and blue lines, and I'm going to plot that gap up here. That gap, or that yield spread, is often called the greenium. That greenium was always negative. Again, that reflects that the green bond always had the lower expected return. So when these bonds were issued, that greenium was a very modest, roughly 1.5 basis point per year. Seeing that, an investor should expect the green bond to underperform. Did the green bond underperform? No. Contrary to expectations, the green bond outperformed. And I'm showing that down below, where I'm plotting the cumulative realized return on a long-short portfolio. This is a strategy where you buy the German green bond and short its non-green twin bond. And what you see is that the green bond outperformed. It had positive excess returns. So now you might ask, you might say, look, the green asset strongly outperformed. Should that lead us to expect strong green outperformance in the future? The answer here is clearly no. You can see that by looking again at the yield spread, the greenium. The greenium deepened over this period. In fact, the greenium was quite low at the end of the sample, around 6 basis points per year. That tells you at this point in time, we should especially expect the green asset to underperform going forward. In fact, the high realized returns on the green asset came entirely at the expense of its expected future performance. So takeaways from this case study: number one, green asset had a lower expected return, but two, the green asset, contrary to expectations, had high realized returns. And third, the high performance of these green assets can come at the expense of their expected future performance. But this, while it's a nice, clear case study, it's still a case study. Most of our results in this paper use data on the US stock market, and I only have time to summarize these results. What we show in the paper is that green stocks outperformed brown stocks in the 2010s. So by green stock, I mean the stock of an environmentally friendly company. Brown stock, that's the stock of an environmentally unfriendly company. This outperformance was quite large. If you look at a green minus brown strategy, that strategy delivered more than 0.5 percentage point per month in return, with very high statistical significance. You can also see that if you construct what's called a green factor, which similarly goes long green stocks, short brown stocks. So what we're finding is that green assets had high historical performance. But we show that green outperformance was unexpected, and it was largely due to unanticipated increases in climate concerns. So specifically, we show that the historical outperformance of green assets vanishes if you go back in history and set climate change shocks to zero. In other words, we're saying the only reason why green assets outperformed over the last 10 years is that there were big increases in concern about climate change. Or put differently, this green factor's realized return exceeded its expected return. Due to time constraints, I'm going to have time really to only to show you one interesting chart. So I will skip to that. I'll skip to that here. Here I'm plotting over time the cumulative return on a green factor. This means what happens if you had bought the green stocks and shorted the brown stocks. The blue line shows that strategy would have had a very, very high return over this period. The red line shows a counterfactual return, meaning what would have happened if there had been no increasing concerns about climate change. And of course, I've had to skip the details of how we compute that counterfactual return. But what we find is that if the last 10 years had been different, if there had not been this awakening to the climate change crisis, the green performance would have been quite flat. So let me kind of skip to what I think are the key messages of our research. Again, our main finding is that the realized return exceeded the expected return for green assets in the 2010s. And again, the reason was that there were these unanticipated increases in climate concern. Why does this matter? Implication number one is for ESG or sustainable investors. They should not expect the very strong green outperformance that we've seen in the past to continue in the future. Second implication is about cost of capital. It's important to remember that cost of capital and expected return, those are the same things. So a naive person would look at the very high past performance of green assets and say green assets or green projects have high cost of capital. In reality, green projects likely have a lower cost of capital than dirty projects. And I think I am out of time and I will stop there and thank everyone for coming. Thank you for the invitation. I need to apologize also that I have to leave shortly after my presentation.
On one of your paper on dissenting the green finance itself. I'm pretty sure that a lot of participants really curious to discuss more about this topic. And ladies and gentlemen, without any further ado, so let's proceed to the second speakers for today, Professor Caroline Flammer from Columbia University, USA. Very good morning, Professor Flammer. So before you proceed to your presentation, please let me to read your short background. So all of the participants, Professor Caroline Flammer is the Professor of International and Public Affairs, Columbia University School of International and Public Affairs. She also served as a chair in the United Nations Principle for Responsible Investment Academic Advisory Committee and also Associate Fellow at the Center for Economic Policy Research and Sustainable Finance and Policy Network. She holds the PhD in economics from the University of St. Gallen, and then she also named by the Web of Science among the top 100 highly cited researchers in economics and business over the last decades in 2020. And without any further delay, let's proceed. And Professor Flammer, platform is yours.
Thank you so much. Thank you so much for the kind invitation. And also it's a great honor to be on this panel among the fellow panelists, among this esteemed set of fellow panelists. So thanks so much. Now, in terms of, we heard in the opening speeches about the importance of the implementation in fighting climate change and getting us transitioning to a low carbon economy. And the question is often how, right? How do you implement it? And I think to answer this question, it's very helpful to actually look at the corporate sector and to understand how does the corporate sector work? How do managers think about all this? And so let me shift gears a little bit and look at it from the corporate sector first, and then I promise I get back to the green bonds at the very end and climate change. So from a corporate perspective, a key question is, do companies and social and environmental responsible practices improve their competitiveness? And the answer to this question seems to be yes, they can. Not always, but they can. And specifically, you can see this along several dimensions. For example, companies' social and environmental responsible practices can foster innovation and prevent knowledge leakage. It can enhance employee governance, and it can enhance companies' competitiveness on the product market as well as on the market for government procurement contracts. And it can help companies sustain their competitiveness during times of economic crisis. And we could also see this during the recent COVID crisis, where research suggests that actually companies that show better social environment responsible practices, that they were more resilient during this recent pandemic. And so overall, and as a result, it's perhaps not surprising that companies' social and environmental responsible practices can positively affect shareholders' perceptions and shareholders' returns. And so the bottom line is companies' social and environmental responsible practices can be beneficial to companies. And as such, you would expect that company sustainable business practices should be integral part of firm strategy and corporate governance. Yet, it turns out that this is often not considered to be the case. Okay, companies' sustainable business practices are often not considered to be core to corporate governance and strategy. And this begs the question of why not? Now, one potential reason is that there is a lack of good corporate governance practices, such as a lack of long-term orientation and a lack of private incentives for managers to care about social and environmental aspects. And before I get deeper into these two studies here, in which we show that well-designed governance structures can improve sustainable business practices and help improve firms' value, let me take a step back and look at the broader business context. Okay, so what do we observe? What are managers faced with? So on one hand, companies and managers are subject to increased risks and costs associated with climate change. Governments increasingly take actions to curb climate change. And a prime example is the 2015 Paris Agreement, in which 195 nations agreed to limit global warming to below 2 degrees Celsius. And the same applies to Indonesia, where Indonesia aims to transition to a low carbon economy. Okay? And so even the threat of stricter environmental regulation can induce firms to reduce their emissions and send a strong signal to the investors of carbon intensive companies. Furthermore, companies are increasingly faced with pressure from social activist groups to address social and environmental issues, and this pressure has intensified with the use of social media. And so, as a result, it's perhaps not surprising that investors, so companies' own shareholders, for example, express increased interest in their portfolio companies' sustainable business practices and exert pressure on their portfolio companies to adopt a longer time horizon, to improve their corporate environment and social responsible practices, and to disclose non-financial information, for example, to disclose their exposure to climate change risks and their strategies, how they aim to mitigate, address these risks. Okay, we can also see this reflected in an increasing number of signatories of the UNPRI, which is the largest network of responsible investors, and the fact that an increasing percentage of all professional managed assets globally are considered to be responsible investment. So there is increasing interest in sustainable investing overall. Now, let me share a couple of facts here that reflect that there's indeed increasing interest and concerns by shareholders about the environment and social responsible practices of their portfolio companies. And I'm not going deeper into this study, but I just want to show you some slides about the increasing trend about shareholder activism demanding their portfolio companies to improve their environmental and social practices. So here I'm looking at shareholder proposals in the US context, shareholder proposals on environmental issues demanding sustainability reports, the addition of minorities and women to the board, animal rights, health issues, human rights, labor issues, etc., etc. Okay, so what you can see when looking at the years 1997 up to 2012, you can imagine over the past 10 years, this trend has even further increased. So you can see an uptick in the number of ESG-related shareholder proposals being submitted, and an increase in the percentage of approved proposals, and an increase over time in the support of investors for such ESG-related shareholder proposals. Now, when you look at the type of proposals that are being submitted, the most often they're related to environmental issues and labor issues. And when you look at who are the sponsors of these proposals, so who are the investors that submit ESG-related shareholder proposals, the most active investors are religious investors that submit the most ESG-related shareholder proposals, but they tend to be relatively unsuccessful in getting the support of other investors. So very active and also a little bit more successful are public pension funds and sustainable responsible investing funds. So overall, in this research, I showed that companies that actually adopt these ESG-related shareholder proposals and improve their environmental and social business practices, they experience an increase in firm value, suggesting that CSR practices are indeed value enhancing. All right, so overall, I think it's fair to say that the advocacy in support of a longer-term orientation, as well as more environmental and social responsible practice, has become more powerful over the years. And so as a result, board of directors may adopt new corporate governance practices to respond to these various pressures, to respond to increased government regulation, increased climate change risks and costs, increased social pressure, increased investor pressure, and to build shareholder value. And two possible governance mechanisms are the linking of compensation, of managerial compensation, to long-term financial performance, as well as the linking of compensation to social and environmental responsible practices. And let me briefly share some insights about this in the following few slides. Okay, first, I'm looking at the adoption of compensation that is tied to long-term financial performance. And before I get there, let me just share with you two things. First of all, in many countries around this world, there's a lack of mandatory disclosure of non-financial information, meaning most companies around the world are not mandated to disclose their environmental and social responsible business practices. And so we are very much reliant on voluntary disclosure. Second of all, from a large literature in psychology and economics, we know that individuals, so not just managers, but individuals in general, are so-called hyperbolic discounters. That means we have an excessive preference for the present. And so it turns out that in many situations, we prefer short-term rewards over long-term rewards, even if long-term rewards are substantially higher. Reasons for this may be cognitive limitations, instant gratifications, impatience, etc. Now, for managers, this myopic behavior is further reinforced by career concerns, analyst pressures to meet or exceed analysts' earnings forecasts, short-term compensation, etc. So as a result, myopic managers tend to favor short-term investments that pay off in the short run at the expense of long-term investments. And so we call this a time-based agency conflict, meaning managers might be even more short-termistic than investors, and hence as a result don't act in the best interest of the shareholders, of the owners of the company. Now, to mitigate this concern, one potential tool is to link compensation to long-term financial performance and to see whether that actually increases firm value. Okay, and so for three possible tools are, for example, the use of restricted stocks, the use of stock options with long-term vesting periods, and the use of long-term incentive plans. Another, besides the linking of compensation to long-term financial performance, another way what board of directors could do is to tie managers' compensation to CSR performance. So this is a relatively recent phenomenon in corporate governance where compensation is tied to specific social and environmental performance goals such as CO2 emission targets, employee satisfaction targets, the compliance with ethical standards in developing countries, etc. This practice is often called CSR contracting, pay for social and environmental performance, or ESG-linked compensation. Strictly speaking, it's not ESG-linked compensation, but rather ES-linked compensation. And the idea is, so as I mentioned before, managers tend to be myopic or more myopic than investors. But in addition, managers are faced with various stakeholders' concerns. Okay, many constituencies are making pressure on companies, and it's difficult for managers to decide, well, which interests are we gonna now address? Many of these interests, they may collide. So for example, managers may face customers with short-term claims about pricing, while environmentalists, they care about the long-term environmental impact on the natural environment. And so what do you do as a manager? So unless incentivized otherwise, managers might have a tendency to address the concerns and needs of those stakeholders with short-term claims and short-term financial implications rather than those of stakeholders with longer-term claims, which might very much be financially material to the company in the long term, but not necessarily in the short term. Okay, and so one way again is to mitigate this tendency to favor stakeholders that are more salient instead of those that are actually really valuable to the company in the long term, is by linking managers' compensation to CSR performance, trying to push them to adopt a longer time horizon and to shift their attention towards those stakeholders who contribute to long-term value creation and hence improve firm value of the company. All right. So this is one specific example of Valero Energy. So you can see the annual incentive bonus performance goals are tied to specific environmental and social performance goals. Let me speed up here. Okay, just wanted to show that this practice of CSR contracting has increased over time. While in 2004, there were about 12% of companies in the US tying compensation to E&S, this percentage has increased to about 37% 10 years later. And in recent years, it has increased even further. Now, when you look at which industries are using ESG-linked compensation the most, it's most prevalent in the mining industry and in transportation and electric and gas. You might first be surprised that it's particularly in these industries that they use ESG-linked compensation. Well, second thought, it's actually not that surprising because it is especially in these industries where the less salient but very much valuable stakeholders are the natural environment and communities. These are stakeholders who are, again, not as salient as customers and employees, but very much valuable to the companies in these industries. So what are the key findings? And I'm slowly wrapping up here. The key findings of these studies are that long-term and environmental and social incentives can serve as an effective governance tool and hereby help implementing some of these climate change and net zero emission targets that we all aim to achieve, correct? More specifically, they help improve firms' environmental and social practices and innovativeness. They help increase the long-term operating performance of the companies and increase shareholder value. So what are the implications for practice? Well, the implications are that essentially the insights of this research suggest that corporate short-termism is really hampering business success. Absent incentives, executives tend to underinvest in long-term projects.
I beg your pardon, Professor Slammer, but you have 1 minute left. Thank you. I'm sorry.
Perfect. No, that's perfect. And this not only hurts companies and investors, but also society and the natural environment. And this suggests that the E&S of ESG is not separate, but rather an integral part of G. In other words, governance is a function of the environmental and social practice of companies. Now, what's next? What are we missing? Correct? When you think about it, most research and most attention of practice is at the firm level and at the portfolio level, not at the system level. So a key question that remains to be answered is how can companies and investors improve their system level investing and help tackle grand societal challenges such as climate change, social inequality, poverty, etc., and what regulatory changes are needed. So for example, and here I'm coming back to green bonds and other ESG fixed income instruments, most research has focused on the pricing of green bonds and the value implications for firms. But what about climate change? How does that really help address climate change? So for example, in these studies here, I show that the issuance of green bonds actually helps improve the environmental footprint of companies, suggesting that green bonds could potentially serve as an important tool in the fight against climate change. Yet, there's a lack of public governance, and in the absence of public governance, there's actually an important role that private governments in form of certification plays. So in other words, this positive impact on environmental performance is purely driven by green bonds that are certified. Green bonds that are not certified, there's an enormous concern for greenwashing, and this is a legit concern. Okay, I stop here. Thank you so much.
And for such another captivating idea on how you see the ESG and sustainable finance on some research that you bring to us tonight. And all of the participants, unfortunately, Professor Tyler cannot join to our meeting until the end. So due to his another agenda, I will bring one of the questions from a lot of participants that are really curious about your question. About your presentation. And this question is coming from Diana from Universitas Glass Maret. In your presentation, you highlighted that the green stock outperformed brown stock unexpectedly due to the highly concern to the climate change. And how do you see that regarding considering there is a developed and developing country and the degree of the concern on both country? And the second question is it possible for participants to access your material? Thank you. So you have the question, Professor, please.
Thank you for the question. And if I understand the first question correctly, you're asking maybe how the results vary between different types of countries,
yes.
Developed versus developing countries. I would love to know the answer to that question. In our paper, unfortunately, we only look at the German bonds and we only look at U.S. stocks. I can point people to some interesting research by different scholars, by Patrick Bolton and Marcin Kasperczyk, who study how stock returns vary across countries. They have many countries in their data set. How stock returns vary across countries in those the returns relation to carbon emissions. So that's one interesting study I can think of. How to access my materials? Let me, if I may, I can add some links to my research in the chat box. I'm happy to do that.
Perfect. Thank you very much. And Professor Taylor, once again, thank you very much for joining and spending your valuable time with us today and sharing such a valuable discussing with us. And have a good day.
Thank
and
you.
Stay
My
safe.
pleasure.
Thank you very much, Professor Taylor. Ladies and gentlemen, so let's proceed and continue to our webinar today. Proceeding to the third speakers for today's webinar. Professor M. Kabir Hassan from University of New Orleans, USA. Good morning, Professor Hassan.
Good morning.
Good morning, Professor Hassan. It's good to see you again. And let me read your a brief of your CV for all of the participants tonight. So all of the participants, Professor M. Kabir Hassan is a full professor of finance and Hibernia professor of Economics and Finance and Bank 1 Professor in Business in Department of Economics and Finance, University of New Orleans, USA. He holds PhD in Finance from the University of Nebraska, and he holds a lot of honors and grants and awards. In 2016, for instance, he is the prize winner in Islamic Banking and Finance Islamic Development Bank, and in 2018, he holds the UNO Gordon H. Nix Mueller International Leadership Medallion. So without any further delay, Professor Hassan, so please, platform is yours in the next 10 to 12 minutes.
Thank you for this wonderful introduction. Since I had a very high impactful researcher presenting their empirical research, data-driven, well-crafted, I'm going to deviate a little bit. So my presentation will be a combination of objectivity and subjective, you can say, polemics. So since I do...
I'm sorry, Professor. Can you put it into slideshow mode, please, so the participant could...
Since
that's
I do work in Islamic finance, so I'm going to bring the Islamic finance in the entire gamut or ecosystem of sustainable and responsible finance. So there is a commonality between ethical finance and Islamic finance because they originate from religious philosophy aimed at creating perpetual benefit to the economy, society, and environment. If you look at the sustainable, responsible, and invest impacting, the total size of this universe is about 30 trillion, And Islamic finance compared to this only 2 trillion, but it is growing. Now, what is the original purpose of finance? It is bringing value to the society. Both has origins, the socially responsible investing, originated from the West in the 18th century from faith-based investing to not participate in sinful activities. On the other hand, Islamic finance originated from the Middle East and Asia since 7th century. Now, as far as Islamic finance focus is serving humanity and uplifting social well-being, and they focus on inclusion in securing economic prospects of every segment of the society, and they would avoid investment that are harmful to society. So what are the commonalities between achieving social good while generating financial returns? The social good, an example will be provision of specific goods or service aimed at benefiting society, and practicing social good, inclusion, dealing with underserved, economic development, and social initiatives. So what are the internal value drivers that I have seen from the previous two presenters, showing support for its employees, providing a healthy and safe environment, examining the entire supply chain, performing corporate social responsibility projects, and discussing social and government issues. So that brings to providing social goods means providing social goods, clean air, clean water, improving healthcare and situation. Now, doing social good means denouncing sinful industries, those that may bring harm to the society. So we want to avoid weapons. You see what is going on in Ukraine right now. Let's help us all that we avoid further escalation. Greater economic environment and inclusion to take into account the impact of climate change on communities, and making finance transparent and easy to understand. So how does Islamic finance help to this ecosystem? It promotes social trust, cooperation, and solidarity. It requires balance between individual rights and rights of society and state. Doing good is encouraged, does not subscribe to encroachment on somebody else's property rights. It advocates fairness, promote comprehensive human development, and stimulate economic activity and entrepreneurship while addressing poverty and inequality. So there is a lot of commonality between ethical finance and Islamic finance. So value proposition in both cases. Ethical finance outlined in the stated intent, environmental sustainability or ESG, can take the all three letters is one of their goals. Islamic finance, on the other hand, is stated intent expounded in the Quran and Hadith from the principle of vicegerency. So the manner and way sustainability achieved, you know, there is a Bandustang report 1987, meeting the needs of the present without compromising the ability of future generation to meet their own needs. And how does Islamic finance achieve it? It treats the environment in fair and just manner, moderation, avoiding wastage and excess, treat every living human being with mercy and duty of care to protect and keep safe for next generation. And the methodologies applied by this both type of finance in ethical finance, different treatment process, negative screening, ESG integration, shareholder activism. On the other hand, Islamic finance, on the top of these three screens, they also use sector screening and entity screening, so-called we call molar filter and financial filter. And you have seen the presentation by two of my previous authors. So ethical finance ultimately contributes to financial stability because it has a long-term orientation. It avoids short-term transactions. It avoids high-risk speculative activities. It governance process in the ESG framework, rightly pointed out Professor Caroline. ESG gets into G framework of this governance framework. High degree of disclosure and transparency, and emphasis on ethics, culture, and values. Now, elements of ethical finance that contribute to the financial stability, the same elements also has in Islamic finance. So elements of Islamic finance that contribute to financial stability, requirement that financial transaction be supported by real economic activity, profit and risk sharing, has built-in risk management within the Islamic financial products, robust governance process, embedded transparency, and avoiding speculative or illegal activities. So both ethical and Islamic finance share common goals, long-term orientation and sustainability, inclusion, ethical values, lead to economic well-being, and preserving the interest of the next generation. But there is some difference in focus. In ethical finance, they put more priority on ESG, and also they're adding value to the society. And Islamic finance, they're more strongly anchored to the real economy. So any financial product has to be somewhere tied to the real economic activity. Otherwise, it will be falling under the parameter of Islamic finance. So it has strong built-in elements of financial stability. And there has been tons of studies done, and I have some mine own, but I will share one study from the Refinitiv. They have used the Sharia compliance screening, and they found that it can significantly, Sharia compliance screening, can it significantly improve environmental, social, and governance performance? The answer is yes. If you include ESG scoring or ESG screening with the Sharia screening, the rate of return is 6% higher for Sharia compliant financial companies, and that number is 10% for Sharia compliant non-financial companies. So yes, Sharia and ESG screening show some correlation. Combining these two can improve our risk-adjusted returns. Greater focus on ESG specific screening on the top of Sharia screening would minimize risk from such exposure. Now, there is Islamic finance. There is one criticism that it focuses only the exclusionary principle. So it is more negative screening rather than positive screening. So the positive screening, the ESG has to be brought more into the Islamic finance decision making. Now, Islamic finance uses screening to avoid financing business built on riba, excessive gharar, alcohol, adult entertainment, etc. Islamic equity, further exclusion screen is applied based on the proportion of impermissible. So this is a financial filter, but what is missing? The positive screening. So that's why we need to bring the positive screening within the purview of Islamic finance. So what are the similarities? SRI and Islamic finance, both approaches have strong ethics foundation. Commonalities include a concern for human rights and the environment. We all talk about, and it's rightly so at this current time, a focus on long-term sustainability and success and avoidance of aggressive leverage. Research report in Islamic finance ESG consideration states suggests a direct correlation between Sharia compliance and higher ESG scores. Already I said the number 6% versus 10%. Now, ESG scores for Sharia compliant companies range from 3% higher for governance to 7.3% and 7% respectively for environmental and social issues. So if I just want to bring some data, so ESG asset under management is expected to represent about 80% of the total asset by 2030. So there are some numbers like CAGR is growing, compound growth at 9% if you take from 2014 to 2019, and it is growing overall in 2013, as I said, 150 all asset management, 120 of ESG asset under management. But if we look at ESG asset under management, and other studies have shown that actually green financing is good, it's not bad. So ESG index performance showed higher resiliency than benchmark during the COVID downturn. So if you start the start of sell-off is here in 2020, market making up is 22, this March 22. And on the average, during the data time period, February 20 March, we have shown that the ESG compliant portfolio gives a better or higher rate of return than pre-COVID time period. Now, when you talk about ESG or asset financing, now sustainable investing is what are the key focus for the asset managers, as rightfully explained by two previous with data. So I just want to give you some basics. So you start with exclusions. Number one, excluding issuers with negative ESG impact, like tobacco, controversies, UNGC's violation. For Islamic finance, it comes to moral filter, riba and gharar and so on, and also the financial filter. Then you have the best in class, selecting companies or tilting entire portfolios toward higher ESG performance. Then you have these thematic funds using sustainability themes like climate. Finance is very popular right now as a basis for allocation towards industry sectors or companies. Then you have the impact investing. You target investing entities that have intention to generate ESG impact alongside with the financial returns. So it is not philanthropy. You want some return back from it. And number 5, you integrate ESG, systematically, explicitly integrating ESG factors into traditional investment analysis and decision making. And finally, you engage. using dialogue, voting, other shareholder actions to urge issuer to improve ESG practices. So now the difference of results that we see, because ESG, even though the data is very porous, so we do not have, there are several vendors who provide ESG data, and they do not really correlate with each other. If we compare like this bond rating by the three big companies, they have a correlation of about 90%, where the ESG rating of companies, the correlation is about up to 30%. So those standard definition of ESG integration leads to big discrepancies between reported and estimated ESG, long way to true ESG integration. So one exercise done by my friend shows that most AM disclose high ESG asset under management as part of the annual sustainability reporting. Boston Consulting Group estimates of ESG asset under management based on Morningstar data hint that those numbers might be inflated because lack of standard definitions. BlackRock, Amundi, UBS are the players with the biggest divergence between self-reported and estimated ESG asset under management. So we have a long way to go towards the true ESG integration. So you have to bring the entire food value chain into the portfolio management. So steps of integration, impact of ESG factors, final output. So the most important part is conduct research and analyze data, information gathering, perspective generation. In this case, the impact of ESG factors are the maximum high, the green means high. Then you evaluate securities, universe screening, fundamental analysis and security. Then fundamental analysis takes a very high for the ESG integration factors. You build portfolio, construction, rebalancing, and monitoring. So what happens in this value chain, material ESG information identified, collect, and structured in the conducting research and data. And the second stage, when you evaluate securities shortlisted based on insights for universe screening and fundamental analysis. And finally, you build portfolio, decision to either buy wholesale based on risk factor and asset allocation objectives. So I'm coming towards very close to my presentation. So what is the foundation of Islamic finance? Of course, it's rooted in divine law. It's an economic justice for all, circulation of wealth, interest concentrates wealth, commoditization or financialization. It has to be backed by real assets for real growth. Risk sharing does not transfer risks to the borrower. So if you compare this conventional finance, Islamic finance, I say landing in a debt-based economy and investing in equity-based economy, win-lose framework in a debt-based economy, and positive sum game in an equity-based economy. It creates debt, financialization in debt-based economy, invest in real assets, in equity-based investing. In debt-based system, risk is transferred, but in equity-based system, risk is shared. Unfair gains for profit and losses from the debt-based system, just and fair profits in the equity-based system. So rich gets richer, poor gets poorer. This is systemic inequity that is increasing. There has been tons of papers and books written by scholars that showing that the income inequality increasing in the debt-based system, and we propose that justice and equity prevail in equity-based system. So how does Islamic finance bring all this together? So in Islamic finance, there is a commercial side and there is a social side. So if you mobilize resources, there are corporation, high net individuals, affluent individuals, upper middle class. So you have the Islamic financial service ecosystem. This is what they call Islamic commercial system. So Islamic financial institution, you have the sukuk, you have the equity funding. But there is also the have-nots in the bottom. So you have the lower middle class, microfinance, micro-takaful, you have the hardcore poor, Islamic social finance, zakat, awqaf, sadaqah, and qardul hasan. So you need to bring the gap. So when you combine Islamic social finance and with Islamic commercial finance in a holistic way, this income inequality will be reduced and the wealth will be distributed more proportionately in order to reduce poverty. So final slide. The paradigm shift, instability, we say that if we go to Islamic finance or the principles I'm talking about, from instability, we'll move to stability, from deception to transparency, from deregulation to regulation, value neutral to timeless values. And I promise this is my last slide. Doing more on ESG issues is helpful to Islamic finance in addressing the criticism leveled against it for putting legal technicalities of Islamic commercial jurisprudence over economic and moral substance. Islamic finance has been learning and will continue to learn from developments in SRI investing, will adapt accordingly. The reverse, on the other hand, that is SRI investing adopting Islamic finance conservatism is less likely to happen because the financial conservatism built in Islamic finance prohibitions does not feature prominently among the priorities of SRI investing customers and providers in its core markets. That said, the better Islamic finance becomes in managing ESG issues, the more likely it is to be accepted as part of SRI investing. Thank you very much. This is the end of my presentation.
Thank you very much, Professor Hassan. What another interesting material from Professor Hassan. As Professor Hassan said, he's one of the best professor in Islamic finance, and he present us about the differentiation between Islamic finance and also ESG. And I'm pretty sure a lot of questions arose from the participants. So feel free to put your question into the chat box, and we will discuss it into the discussion session. So, ladies and gentlemen, 3 speakers coming along from the US. And another speakers, the 4 speakers will be coming from the UK, from the Europe land, and Dr. Renata Skizis. So, very good afternoon. And let me read your brief of CV. So, ladies and gentlemen, Dr. Renata Skizis is Associate Professor in Finance within Southampton Business School at the University of Southampton, UK. Prior to his position, he was the Senior Lecturer in Economics and Finance, University of Portsmouth. He holds PhD in Economics from Universidad de Akan, and then one among a lot of honor grants and award is Circular Economic Modeling and Empowerment Perspective in a Small Open Economic and funded by Council of Lithuania. Without further delay, Dr. Renata Skizis, the platform is yours.
Thank you very much. Let me share the screen. Okay. So let me know if you can see the presentation slides. Okay.
Okay, perfect now. So please.
Okay, so thanks again. My research talk is, or asks and tries to answer the question, does genetic diversity on corporate boards lead to improved environmental performance? And I must say that I'm pleased that my talk is scheduled after Caroline's, because we're sharing, I think, our research interests. Yeah, there's a significant overlapping between our research, and I must agree with most of the points raised also by Caroline. In general, it was good to listen to all of the previous speeches here, so I'm pleased to be part of this panel. And so this research is joined with my colleagues Manuel Mamotzakis from Birkbeck and Panayotis Zouvanas from University of Sussex. Right, so it is related to corporate governance. So I'm looking at the flip side of impact investing, and from a broader perspective, I ask the question: what makes firms an appealing vehicle of impact investment? And as we already know, firms across the globe have increasingly come under scrutiny and probably pressure from stakeholders to reduce their carbon footprint and to improve more broadly their environmental performance, increase environmental innovations, reduce resource dependence, particularly from fossil sources. Okay, so increasingly more environmental and carbon performance has been enshrined in firms' overarching business strategy. And so there has been recently a lot of research on sustainable finance and boards diversity. there has been different types of diversity looked at: gender diversity, cultural diversity, also ethnic diversity. So my type of diversity is genetic diversity or ancestral diversity. Yeah, and so to avoid any controversy, I'm not looking at particular ethnic groups or genes, but I'm looking at how, what is the value really of having a more diverse board in place. Yeah, so a diverse board formulates corporate policies, creates governance mechanism, and also provides both means and an end of corporate social responsibility. However, in this body of research, there is little knowledge on the role of board's genetic diversity on firms' environmental and carbon, and also social performance. Okay. So I agree with also Caroline that well, we have very strong influence of stakeholders who steer companies towards more sustainable environmental and carbon performance. And so, recently there have been board diversity pledges made by large multinationals such as Bank of America, Merrill Lynch, Facebook, Google, among others. Yeah, and so these pledges were mainly driven by large institutional investors. This has been also shown in research, and also other stakeholders, external stakeholders, including regulators and policymakers. However, again, there is little knowledge in the role of boards' genetic diversity on firms' environmental performance. Yeah, so therefore we argue that boards' diversity, yeah, can be a key impetus in promoting corporate environmental and carbon performance. Now, you can ask, why is that? And there are different reasons. Prior research shows that boards' diversity is associated with new, smart ideas, which translate into superior business solutions. Yeah, and enables firms to thrive in fast-changing business environment. Then there's also research that shows that boards' diversity can promote innovation and productivity at the firm level. So this was documented by Griffin and others in 2021, right? And also in terms of the agency theory, board needs to monitor managers on behalf of their shareholders, right? So in order to mitigate information asymmetries between ownership and control of the company, right? And so the board needs to be endowed with appropriate mix of experience, expertise, and qualifications that can be provided by a diverse board of directors. Yes, so in our view, board gender diversity can be regarded as an effective tool for monitoring managers. So how the firm adheres to environmental strategy and implements environmental policy, right? So that can be part of agency theory. Now, what are our contributions? Yeah, so as I mentioned, we aim to ascertain whether both genetic diversity is conducive to improved environmental and carbon performance, and also like joint ESG performance. And so our contribution is threefold. So first of all, how boards genetic diversity influences ESG performance. Second, what is the relation between corporate environmental and carbon performance and boards genetic diversity? And then we also look at the corporate transparency in terms of again, carbon and environmental performance. So whether companies disclose and what drives those environmental and carbon disclosures. Okay, so in terms of data, we obtain data from Bordex on corporate governance. Then we also retrieve data on financial variables from Thomson Reuters, WorldScope, and DataStream. All of our environmental variables, so ESG, environmental performance, and also carbon performance, come from Refinitiv. Now, genetic diversity scores are from Ashraf and other authors, their paper in 2003, right? And we use a number of other sources to construct our control variables. So our initial sample consisted of more than 112,000 firm-year observations. Yeah, our focus is on the US sample, not least because we have most of our data come from US companies. So then what we did was to match financial and environmental variables with corporate governance data. Yeah, and so our reduced sample is of 19,000 observations. So our panel, and we use panel data models, consists of 3,690 firms observed from 2005 to 2019. Okay. So our genetic diversity score measure builds on an index of the country's genetic diversity score, which was provided by originally by Human Genome Diversity Cell Line Panel, right? And so the use of this genetic diversity or ancestral diversity score is motivated by the research in anthropology, right? So research in anthropology shows the presence of 53 ethnic groups, which are historically native to their current geographical location and have been isolated from genetic flows from other ethnic groups. Okay, so just very briefly, our genetic diversity score is really the standard deviation of individual scores of members of the board. And so it measures how each member's genetic score deviates from the average genetic score. Yeah, and similar measure was used by Delis and others in their paper published in Management Science in 2017. And so they studied the relationship between genetic diversity and firm performance. Okay, now let me also explain how we measure corporate carbon performance and environmental performance, right? So for corporate carbon performance, we take the total volume of greenhouse gas emissions by firm I in year T, and we normalize this by total assets of the company. Yeah, take logs and take the minus sign. So the minus, this means that higher measure, higher score reflects higher carbon performance. Now, our second dependent variable is the natural logarithm of the corporate environment performance score. This is number index that ranges from 0 to 100. But this corporate environmental performance is also reported as a categorical variable in 4 categories: D, C, B, and A, quartiles. And it is further subdivided into 12 subcategories or grades. Yeah, so given these categories, and given also the fact that originally it is measured as index numbers. So we have used linear and nonlinear discrete response models to estimate their relationship between corporate environmental carbon performance and genetic diversity. Okay, so just to provide you a brief overview of our empirical models. So our key explanatory variables is genetic diversity, and our control variables are financial indicators of the company, so which indicate corporate finance, the governance indicators, diversity measures like cultural diversity, gender diversity as well, control for, and then different indicator variables for the year, industry, and state in the US. Like I mentioned, our sample focuses mainly on the US, although we also use an extended sample for this. So first is our linear model. The second is a nonlinear discrete response model. And so we use ordered, logit, and probit models as our discrete response models. Okay, let me show you some preliminary findings here. All right. So if we look at the variation over time, yeah, in pollution and corporate environmental performance for firms with genetic diversity and without genetic diversity. So looking at the top graph, we can see that firms in which the board of directors is not genetically diverse tend to pollute systematically more than firms which are genetically diversified. Yeah, and this is the case throughout our sample period from 2005 to 2019, and particularly in the years like 2009, 2010, 2011, we see biggest differences between two categories of firms. Now, looking at also at the bottom panel, we can see that there is evidence that firms with genetically diverse boards of directors tend to perform environmentally better than firms without genetic diversity. Yeah? And this was particularly the case from 2009 to 2019. So these are our initial findings, which are quite encouraging and also motivates us to dig deeper into this relationship. Yeah, so looking at our baseline findings, our linear panel models, yeah, so we look at different model specifications for CCPAs, corporate carbon performance to assets ratio, if you like. And the second block is corporate environmental performance. Yeah. So the coefficient estimates that are highlighted here, as circumscribed in red, so indicate that in all cases, there's a positive effect of genetic diversity on corporate carbon performance and corporate environmental performance. Yeah, so our results are robust. We also have looked at different model specifications. So here what we do is to use contemporaneous explanatory variables, and that of course raises endogeneity issues. And so we deal with endogeneity and reverse causality in different ways. So first we use lagged explanatory variables to ensure that there is no reverse causality. And also because there might be some selection bias. So what we do, we use as well an instrumental variables approach, where we instrument genetic diversity with several established instruments. and so the results are not shown on the slide, but we obtain similar results. Okay. We also have looked at different diversity measures. So in line with genetics research, instead of the genetic diversity based on human genome genes data, we use ethnical fractionalization measure, right? And so what we find again is that in more diverse boards, corporate carbon performance and corporate environmental performance.
Dr. Renatus, I'm sorry, but you have 1 minute left. Thank you.
Okay, yeah, and so I'm about to finish here. I haven't yet mentioned my results about environmental and corporate carbon disclosures. So what we also find using discrete response models, ordered logit and ordered probit models, is that higher genetic diversity leads to higher corporate carbon and even ESG disclosures, right? So that's what we find, is that board's genetic diversity can improve corporate environmental and carbon performance, right? And also firms which are more genetically diverse, they are also more transparent in terms of their say greenhouse gas emissions. And so it can also provide the source, basis for different regulatory incentives and policies. So thank you very much.
So, ladies and gentlemen, that was Dr. Renatus Kizis who discussing about does genetic diversity on corporate boards lead to improve the environmental performance, and we can see that from his paper that the genetic diversity does improve the environmental performance of the bonds. And I'm pretty sure a lot of mind on the participants for today regarding the presentation of Dr. Renatus Kizis, but hold on, we will proceed to the question and answer session after the last speakers, Dr. Putra Pamungkas from Universitas 11 Maret Indonesia. So, good evening, Dr. Pamungkas. Thank you for staying with us. And then before we proceed to you, let me read your brief of CV. So, ladies and gentlemen, Dr. Putra Pamungkas is a researcher at the Center for Fintech and Banking Universitas 11 Maret and also assistant professor at the Faculty of Economic and Business Universitas 11 Maret. He's quite young and he holds his master and a PhD in economics from Université de Limoges, France. Without any further delay, proudly forward to you, Dr. Putra Pamungkas. Platform is yours.
Well, thank you very much. Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, and good evening, distinguished speakers. It's been an honor for me here to speak with the very distinguished panel today in this very significant event about the sustainable finance and impact investing. Today here, I would like to share about our recent research and previous research about this sustainable finance and also impact investing. So today I would like to discuss about the SME flight to digital and green economy. I think that as Professor Wimbo and General Luhut in the previous speech was talking about this kind of important things for the presidency of G20 for Indonesia, that the three main issues that we raise in this presidency for this year is about the SME first, and the second is for the digitalization and all digital economy. And the third is for the sustainable finance. So this three issue is very important right now for Indonesia. So therefore, I would like to discuss about how SMEs that flag to digital and transform to the digital era right now, and how that transformation can affect the implementation of green economy, that what we call right now the new term of the green economy. So basically, as also maybe mentioned before, that the small medium enterprise SMEs are the main driving sectors and the backbone of the economy of Indonesia. So based on a lot of data that SMEs provide labor incentive, and also the contribution to the GDP in Indonesia itself is up to 60%, more or less 60% of our total GDP. And it is really emphasizing that SME have a strong contribution to the Indonesian economy. So, and also as one of the sector that driving Indonesian economy right now is the digital economy also. So basically the SME needs to, kind of adapt and start to using and utilizing the digital technology, and adopt the digital technology as their business process and business model to increase the competitiveness of the SMEs. So the importance of the technology adoption and the capability for micro, small, medium enterprises, it's been a lot of studies saying that it can be improving their competitiveness and also performance. So several factors from the digitalization process that could impact SME business model. It is kind of motivate us to investigate the determinant of the adoption of the digital technology. So also the effect of digitalization is more pronounced during this pandemic COVID-19. So COVID-19 basically sieve the behavior of people due to moving restriction and lockdown policy in several places, including in Indonesia. So I would like to share some of the kind of what we are questioning here is we try to clearly understand that the barriers of SMEs using the digital technologies in Indonesia, and also we investigate whether the condition is different between during COVID-19 pandemics, which is start in 2020 until now, but we are having the survey in 2021. So which is arguably that the COVID-19 pandemic, which arguably increased the adoption of digital technology significantly. So we also does the SME of digital transformation affect the green economy implementation, especially in Indonesia. So how we define the digital transformation basically for SMEs. So we of course we're following the several literature before that we define the digital transformation as they use the online payment in the daily operations, and also they conduct kind of a digital marketing through social media usage, and also a point of sales. They currently have a software to record their daily transaction, which is really rare in small businesses in Indonesia. And also right now, because of the digitalization process, we have a lot of big e-commerce, a lot of big marketplace that can be defined as a unicorn, in startup unicorn right now, and it really helps the SMEs, Indonesian SMEs, especially also in Asia, to escalate exponentially, and because of this kind of a transformation in digital era or digital development. And why is that? Why digital transformation is so important for SME? We think that it is really important right now that the transformation for SMEs is because by doing the transforming the business process through the digital, it can expand the market share through the marketplace usage or also e-commerce, and also improve performance based on the several related literature, and also it can also increase the efficiency and reduce the cost. And basically arguably also it's improved the productivity because of it's increasing the sales and something like that, and also it encourage SME to be more innovative, to increase the innovation in their product and services basically. So so we have recent papers that we conduct a survey for around 222. It's really a beautiful number for micro small enterprises in Indonesia. This is across industry such as a local commerce, shop, services, and agricultures. So basically we investigate the use of digital finance technology, especially digital payment by small businesses in Indonesia. So our main result here, we find that during COVID-19 pandemics, firms or small businesses that have a higher selling and income most likely adopt digital technology such as online payment and also online marketing. They conduct online marketing. So we find also interesting findings here that the digital literacy of its owner or the owners of the SMEs is increases the likelihood of using digital technology in their businesses. So we ask again the questions whether this transformation of the digital technology for SMEs is really good for SMEs, and we ask the question whether this kind of transformation, this kind of the shifting behavior from the conventional to digital business process will impact on the green economy. So green economy is one of the result in improve human well-being and social equity while significantly reducing the environmental risk and ecological scarcities. So it is low carbon, resource efficient, and social and inclusive. So basically, we ask whether this transformation in the survey also whether this whether they have a knowledge about this kind of green economy, whether they conduct kind of the green economy operational, and also the knowledge operational, and also the awareness of the owners that have the higher digital literacy. So because we see that in the news, not only in the news, that digital kind of the use a lot of electricity, a lot of kind of something like that most of the developing country especially we use the electricity from the non-renewable source or resource or not renewable resource. So therefore digitalization that going so fast, they use a lot of electricity, is not, and the source of the electricity is not from the renewable renewable source, is really an issue here. So we ask the digital transformation affect the environmental issues. So it can be also if they are aware of this kind of green economy implementation, it can be a sustainable economics, can be green economic, and also the important of the implementing green economy on SMEs business model. So it can be win-win solution that the transformation is also increase the awareness of the implementation of the green economy. So we find also in our basically the regression or the research that we conduct last year, is that both foreign and domestic investment right now are detrimental to environmental quality. So this is really an issue right now in Indonesia, that the investment should be also be regulated to be more environmental friendly. So our green economy implementation here, we asked the question about this green economy awareness, about the operation sustainability, and also the knowledge. We asked the question during the surveys. So basically the surveys and still in progress, and we're still collecting the data. So I cannot really conclude the calculation, but our very preliminary results that we survey more than 2,000, but we still, kind of increasing the number of a sample that our results shows that the SME's digital transformation has a also positive and significant relationship associated with the green economy implementation, which are the awareness, the operation business operation, and also knowledge during the green this kind of implementation. So this is the pictures that I got from last year from speech from Nobel winner Robert Engel, that this is he speak about the climate risk, that this is really important for us now to think about the climate change, and also thinking about the other problems that behind that problem is we have a big problem that is climate change too. So this is, I think, the end of my presentation. So thank you very much for the time for sharing, and also I'm happy here and honored to be between the very distinguished panels speakers today. Thank you very much. I will come back the platform to Ms. Dewanti.
Dr. Putra Pamungkas for delivering another point of view on how we see our theme today, sustainable finance and impact investing. And Dr. Putra has delivered on to us about the SME flight to digital and the green economy, and share us about one of his research. And we will proceed to the question and answer session. So we have received a number of questions that the participants that joining us are really curious and passionate about what they delivered by the presenter today. And as the first question is from Mrs. Yasmin, and this question is for Professor Caroline Flammer. So this question is for you, Professor Flammer. The question is about what type of incentive the government or maybe the investor could offer to encourage companies to be more involved in the climate change mitigation. So do you get the question, Professor Flammer?
Very good question. Thank you very much.
So please.
I would say there are different levels, right? Are we talking about incentives that the board of directors could provide to the managers, which is, for example, linking compensation to specific climate change goals? But on the other hand, also at the more macro level, for the government, thinking about potentially policies about disclosure and what kind of disclosure. So there's a lot of conversation, for example, about scope 1, scope 2, scope 3 disclosure. And what we need to be careful about, and I try to keep my answer short, is if, let's say, we only look at scope 1 disclosure, which is the direct emissions of the companies, then there's a risk that if only scope 1 emissions disclosure is mandated, that what companies would do is they divest their most emission intensive operations. And so basically they outsource their climate change to other companies, to other suppliers, for example. But at the end of the day, it would not change anything at the system level. It would not help us mitigate climate change because it's just a shuffling around of emissions. And so I think from a government's perspective, public policy perspective, we want to be very careful about taking a systems level approach as opposed to firm level. That's what I was referring to at the end of my presentation. Companies and investors alike, their focus at this very moment is very much at the firm level and at the portfolio level. But that does not take into account those side effects that might be triggered. And I think what we really need is thinking about what's the actual impact on the broader environmental system.
Thank you very much, Professor Flammer, and I hope it satisfied the question of Mrs. Yasmin. And then the next question, let me proceed to the next question. It's the question from Mr. Fauzi. So it's a question from for Professor Hassan. So can you hear me, Professor Hassan? So this question is for you.
Yes.
It is interesting to learn that Islamic value actually promote ESG value. Would you please elaborate on how we can introduce more Islamic value to the financial sector without making it sound exclusive to the Muslim community only? So please, Professor Hassan.
Okay, first of all, I mean, the premise of your question is not totally correct. So Islamic finance is not only for Muslims. This is, even though it starts from religious values, but you do not have to conform to these religious values. All you have to agree to the contract. So, but second part of the question is very important, that if my own study of looking at the Islamic banking performance, so they are prohibition-driven industry. So you cannot do this, you cannot do this, you cannot do this. But we are looking for positive screening or positive social aspect of it. That's where the ESG is coming in. Let me give you an example. So an Islamic bank, gives a loan to a company. So the Islamic bank really should ask how this money is going to be spent. I mean, Islamic facility, I'm talking about Islamic, whether it's a Murabaha or Mudaraba or Musharaka type of financing. So they have to ask all these ESG questions. Is this facility is going to promote environmental degradation? Is it going to promote less gender equity or not taking care of our workers? But so the Islamic finance industry is not gone to this level, and they really have to address these questions. This conventional counterpart is making a very good progress in this area, and there has been good empirical research, as Caroline and Luke has shown. The data is there, but unfortunately for the Islamic finance industry, the data is not there in order for us to answer this question. So for young researchers, I would ask you, and also the government agencies, to collect this data. Without collecting the data, how we can ask those scientific questions? So that will be my brief answer.
Thank you very much, Professor Hassan. So to proceed to the next question. This question is for Dr. Renata Skizis. This question is from Mrs. Fiani. So Dr. Kizis, would you please to explain why does the relationship between two interested variables is more prominent in the US-based company? Could it be more because the economic condition or regulation? Thank you.
Yeah, so I must say that we control also for economic conditions, but regulation varies in the US across states in terms of environmental performance here, and so we can't really control for that. Now, I guess one reason could be that there's more data for the US companies, and also more information about who are on boards of the US companies. And so there are, I would say, more than 80 nationalities. Yeah, but some nationalities are more prominent, like, well, if I can have a look quickly, some nationalities are more prominent. Yeah, such as, for instance, British, Canadians, Germans, French, Australians, Indians, Dutch, Mexicans, Italians, Swedish, and Swiss in the US. Yeah, so so the fact that in the US there are many companies with many diversified boards actually probably determines this result. I'm sure that answers your question.
Thank you very much, Dr. Kizis. I really hope also that your answer is satisfy the questioner. And then the next question is to all of speakers. So it's include Dr. Pamungkas also. So be prepared to answer this question. So because this question is about Indonesia. So it's question coming from Dila. Could you please give your perspective, where is the position of developing country like Indonesia pertaining to practice of the sustainable finance and the green economies, and what is the challenge to do that for like developing countries as Indonesia? So probably Dr. Pamungkas, would you please to answer first?
Well, I think it's very good question is about the practice of sustainable finance in Indonesia. As maybe Professor Wimbo in the beginning explained about regulation, about this taxonomy of the green economy and sustainable finance. I think the most important things is also related to Professor Flammer's presentation is about the disclosure of the CSR, disclosure of the sustainability reporting. It's very important for a company right now to report that publicly. So for investors, for example, can really understand the companies that have contributed to the environmental issue, something like that. So, but that was the issue in Indonesia right now. So if that can be regulated and can be disclosed publicly and everyone can access that, I think that would be the step for us to have sustainable financing and also investing in the environmental in the company that concern in the environmental issues. I think that's my answer, Ms. Dewanti.
Thank you very much, Dr. Pamungkas. Quite interesting perspective on answering. And Professor Hassan, yes, I think you have something to add on.
Actually, I must tell, this presentation by the minister or the professor, I don't know who was there. There are 6 countries has already adopted the sustainability reporting. So out of the 6, 3 are developing countries and Muslim countries, Indonesia, Malaysia, and my own country of birth, Bangladesh. Even though Indonesia in this value chain is latecomer, but Indonesia has started the Islamic finance movement or the developing this is a more holistic way, bringing the all aspects of Islamic finance together, commercial finance and social finance. So I see a very big hope that Islamic finance actually will see the spirit, not only in the form that will be practiced in Indonesia, and that will ultimately will generate positive social values for everyone. And the report that the minister or the professor presented, I don't remember, very detailed, the different phases. So I think it's in the right direction. And probably it will be an example for other countries to follow. So in Indonesia, I would say very much ahead of the game than everyone else. So kudos to Indonesians.
Thank you very much, Professor Hassan. And for the next, Professor Flammer, do you have something to add on regarding this question? Thank you, please.
I'd be happy to. I probably have the least expertise about Indonesia, per se, among all the panelists, but let me just share some observations. So when you look at, for example, the issuance of green bonds, so there's a great potential for Indonesia. So Indonesia has issued green bonds in the past, but I think there is further potential to even increase the issuance of green bonds. Now, if you think, and I totally agree with my fellow panelist Kabir Hassan about the leading role that the Indonesian government now aims to play in terms of transition to a green, low carbon economy, and in establishing, for example, the taxonomy. Now, when you look at sustainable finance impact investing more broadly, there's enormous concern about greenwashing, for example, and one of the reasons for this concern for greenwashing is that there's a lack of public governance in many countries around the world. And this lack of public governance, so this is where private governance steps in, and so the role of certification in certifying that indeed, for example, green bonds, that issuers of green bonds are serious about investing the proceeds of those bonds into green projects. But if you think about how do you foster sustainable finance and impact investing in Indonesia further, is, for example, by mitigating some of these concerns by, for example, implementing some regulation around, for example, if you think about green bonds, there's an ambiguous definition of actually what is green, correct? There are multiple taxonomies that may actually impede the effectiveness, efficiency, and integrity of the market. There's also currently the certification, this private certification is binary, so either a bond is certified or it's not, and so probably a tiered certification scheme would help and be more informative to investors. So at the end of the day, investors aim to assess their portfolio companies or what are they really serious about improving their environmental footprint. But it's very difficult to make this assessment if there's a lack of mandatory disclosure and if the definitions around green is very ambiguous, correct? So anything that would help in transparency, in making it more clear, and providing information to the investor community would likely help foster the transition to a low carbon economy and have real impact, not just about greenwashing.
Completely agree with Professor Flamber. Thank you very much. And I think Dr. Rentatskis also have something to add on. You raise your hand, so please, Dr.
It's getting, this debate, this conversation is becoming very heated. So I would also like to contribute to it. In my view, I agree with the previous views, with Caroline as well. But I think the driving force within the economy would be, the end consumers, right? So they decide what to consume, which products to buy, and that drives also productive activity of the economy, right? So if their preferences are geared more towards like environmental quality, social performance, government performance of the companies, so eventually the productive activities of companies will follow this suit. And that is very important. And people preferences do change over time, hopefully in the right direction. Yeah. So education is one thing that can actually change their preferences or steer into the right direction.
So thank you very much, Dr. Renataskis. And I'm afraid that would be the last question for our question and answer today. I'm pretty sure that a lot of question has been on mind on the presenter, and what about 30 minutes is not enough to discuss like a bunch of material that we've been discussing today with the 5 of speakers today. And before we end our meeting, I think it's good for 4 left speakers to give like the final statement regarding our meeting today. So the first, I think, Professor Caroline Flammer, would you please to give the first final statement for today's webinar, please.
Thank you very much. And thanks again for the invitation, by the way. So I would say, be it policymakers, be it investors, or be it managers, and I think what we really need is to think about how can we really mitigate climate change? How can we really tackle some of these system-level challenges that we are facing? And for this, we really need to adopt the system-levels approach and not just thinking about the company level or the portfolio level. And I stop there.
Thank you very much, Professor Caroline Flammer. And second, Professor Kabir Hassan, please.
Well, 2 parts to my final comments. The first part, I tremendously benefited from the presentations by Luke, Caroline, and Renatas. Very high impact, very well executed empirical research to answer objectively what is happening in climate, ESG, and social responsibility impact investing arena. Secondly, I would slightly differ with Caroline's comments. Yes, system level is important. That's the macro perspective, but the micro perspective is also very important to me. We have to really, if you take the banking industry, we have to look at your loan portfolio. And this international development agencies are already using this. So when they give a loan to a developing country, so they look at different types of analysis, and ESG is one of that analysis as well. So I would say that that should be injected at the company level and most important at the product level. Because you have been saying this Islamic finance product is different than a conventional product, but we have to show how is it different. If you take any big Islamic bank in any country, I mean, their clients are all big corporates, right? The small fish like me cannot get a loan from there. I mean, financial facility in an Islamic way, because I'm not a insurable risk to them. So where does this, the value orientation of Islamic finance come into play? So this is what we have to really put emphasis on. And final point, as Renata said, education is very important. But I would say the Indonesian government, they have this every year. They have this Sharia economy month. They do different types of conferences. They invite speakers. They try to educate the citizens about the Islamic finance, the value system. That is also, in the long run, will contribute to clear adoption and contribution of the Islamic finance for the development of this industry, as well as for the benefit of entire Indonesian citizenship. Thank you.
Thank you very much, Professor Hassan. Next, Dr. Renata Skizis, please have your closing statement for today's webinar.
Yeah, so it has been said so much that it is very difficult to contribute anything new, but I will try. So I'm pleased that the moderator yourself, when you introduced me, you mentioned that I contributed to this project on the circular economy and the small open economy, which was funded by the Research Council of Lithuania. So within this project, we looked at how it would be possible to make economic activities more circular. So that involves, of course, company, but not only the company, the whole supply chain. So it is very important to create sustainable supply chains, and also to ensure that the resources are used, efficient use of resources, and resources that are used not related to, say, fossil resources, that those resources are really renewable, if possible at all. But circular economy has many different aspects, such as the packaging, waste management, innovative activities. So I think it is very important to work, collectively on all those aspects to ensure that also the economy, as a result, becomes more environmental friendly, less polluting, but also more socially friendly for workers and also for communities.
Thank you very much, Dr. Renata Skizis. And last but not least is Dr. Putra Pamungkas. Please have your closing statement for today's event.
Okay, I think this is the momentum of Indonesia as the to lead the presidency of G20 and raise the issue about the sustainable finance for the world. So we kind of support that issues, and as on behalf of UNS Fintech Center, I would like to say thanks to all of the speakers here that have shared their ideas and also research, and we are really happy to have you here. So Indonesia is committed to this kind of sustainable finance and impact investing, and as Professor Kabir Hassan said, we are the program, we have a lot of program, even including the green sukuk. We have Professor Hassan. So it's Islamic bonds that committed to the environmental issues, environmental investment. So thank you very much for all of the speakers and also keynote speakers and also the participants. Thank you.
Thank you very much, Dr. Pamungkas. Probably it could be the one last question to all of the speakers. Is it okay for participants to access your material, or probably you can give to the committee and we can broadcast us and send to the all participants? Is it okay, Professor Hassan, Professor Flamber, and Dr. Kizis and Dr. Pamungkas?
Yes, it is okay.
Okay, perfect. So I'm afraid that was the end of our meeting today, and I'm really sorry. I humbly apologize to all of participants that I cannot bring all of the questions due to the time constraint. And before we end this meeting, I would like to wish happy 46th anniversary to Universitas 11 Maret. And then I would like also to say thank you very much to Indonesia Financial Service Authority, OJK, to fully support this event, and all distinguished speakers, Mr. Luhut Binsar Panjaitan, Coordinating Ministry and Maritime and Investment Affairs of Republic Indonesia, Professor Wimbo Santoso, Chairman Indonesia Financial Service Authority, OJK, Professor Lucian Taylor, Professor at Wharton School, University of Pennsylvania, USA, Professor Caroline Flamber, Professor at the Columbia University, USA, Professor Muhammad Kabir Hassan, full professor at University of New Orleans, USA, and Dr. Renata Skidis, associate professor at University of Southampton, and last but not least, Dr. Putra Pamungkas, researcher at the UNS Fintech Center, Universitas 11 Maret. All invited attendees, and last but not least, all of the participants who have been willingly to join this event until the end. That accesses this meeting via Zoom or our YouTube channel. I'm Dewanti Chiningsi on behalf of organizing committee sign off. Thank you everyone. Stay safe and hope to see you in the next event. Bye.